Good evening, everybody. Hope everybody's having a nice this fall evening. It's got to be fall. I had the guys come today and put the cover on the swimming pool. What a sad, sad day. Okay, tonight we've been requested to go kind of back to the basics, or not kind of requested. We're getting a lot of people that were, we've had a lot of people come into the chat room, but the questions were all the same as far as what were the signals? What signals did you see, or what makes up the signals? And the whole basis of candlestick analysis is the signals. There are about 50 or 60 signals in candlestick analysis. We've narrowed it down to 12 because out of the 50 or 60, most of them don't occur often enough to spend mental time and energy trying to learn them. So through the years, I discovered that these 12 major signals, if you just concentrate on them, you're going to have more trades and more understanding of when a reversal is occurring in the marketplace or any trading entity that you're doing than anything else. And the great advantage of the signals is the 400 years the Japanese race traders have identified these signals. Not only did they show us the graphics of what they look like, but they also explained what the psychology was that created those signals. Now, that may not sound extremely important, other than the fact that prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And the perception of fundamentals is basically what the candlestick signals are. They're the graphic depiction of what's going on in investor sentiment. So the reason we're going back to the basics right now is that, let's see, make sure I didn't goof up my microphone, is that this market, obviously, as we've seen, has been very, obviously very sideways and very choppy, not even choppy, just sideways over the last, definitely over the last 4 or 6 weeks, and definitely over the last 4 months. So what we're kind of doing is, again, we're getting a lot of the new people in the chat room, but the bread and butter, the bricks and mortar, the very basis of candlestick analysis is understanding prices move because of investor sentiment, and there's just one very simple explanation. This is the most important aspect of candlesticks, and this graphic or this slide is so plain is because I did this probably about 12 years ago and have just never changed it. But the definition of candlestick analysis is that the signals are the result of the accumulative knowledge of everybody buying and selling during a specific time frame. So investor sentiment can be identified not only on a daily basis, weekly or monthly, but if you're trading intraday, I used to trade the E-minis on the 1 minute, 3 minute, 10 minute combination. So before I get started, the 12 major signals are these, and we're going to go through them real quick. But another element that has completely added to the success of trading in the right direction at the right time is what we call the T-line. The T-line is the 8 exponential moving average, and it's got Fibonacci characteristics. If you kind of analyze any chart that we have, which we'll see is very simple, we've got the 200, the 50, and the 20-day simple moving average on these charts. Now, I know for the people that are in the room all the time, this is elementary and kind of review, but it has proven itself time and again that these moving averages act like magnets because every major money manager around the world use this to make their decisions about what goes on or what to do at those moving averages. Randy, I don't know why you can't see anything. Now, the T-line has a very simple rule. The T-line is the 8 exponential moving average, this black line. And there's one very simple concept. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close below the T-line. Chrome worked? All right, that's good. So I used to make good money trading candlesticks without the T-line, but I got whipsawed in and out a lot of times. So if I got out of a trade without the T-line, I probably didn't get back in or stay in because I probably moved on to something else. Now I know as long as it doesn't close on the T-line, I can just stay long. And that works equally well both on the long side and the short side. So it makes staying in a position very simple. We've got a lot of trade setups like the 45 degree that we know we can stay long until we see that sell signal and a close below the T-line. So as we go through this, we're going to find out there's a lot of candlestick signal truisms. And it makes the visual identification of what's going on in a price trend very simple to identify. If we see a candlestick sell signal and a close back below the T-line, and we can add other things like the resistance level of the moving average, the 50-day moving average, that told us exactly what was happening when we got up here. They were selling at the moving average. So not only do we get out of long positions, we can go short. We also have the truism that the further away you move from the T-line, the higher the probability they're going to come back and test it. So if we know simple rules, which we'll get into here real quick, on each of the signals, we know with extremely high probability that if it opens lower after a doji in the overbought condition, and again, my overbought and oversold conditions are based upon stochastics of 12.33, and that's nothing set in stone. That was just one night I sat, probably a good 40 some odd years ago, and said, all right, what stochastics equate to the tops and the bottoms? The standard at that time was 14.55, but that seemed a little bit too slow for what I was doing. So it just puts the probabilities of if you see that trading that far away from the T-line and a signal and it confirms the next day, close it out. Worst case scenario is it doesn't J-hook pattern, which is one of the patterns of candlesticks. You can always buy back in. But why hold on to something when it might be heading in this direction? Okay, so again, the 12 major signals. We're going to go through them real quick. And the reason we're doing this is, again, because this is the bread and butter of understanding why prices move like they do and when they move. We are going to be doing a 2-day training seminar this weekend. And we start with the 12 major signals. That is the bricks and mortar. If you understand what's happening in each of the signals, then you have a much more clear, concise concept of when to be buying and when to be selling. So the doji, we know, is an open and a close at the same level. I have different names for them. The gravestone doji, the Japanese rice traders explain as the warriors coming out of camp, going into battle, getting beaten back into the camp by the end of the day, leaving their dead all over the field. That's the gravestone doji. The T-line is the 8 exponential moving average. Again, let me go back to the T-line. And remember I was saying how the T-line was the 200, the 50, and the 20 are on every major money managers' charts, and they use those to make their decisions about their portfolio. So those act like magnets. Everybody has them. The proficiency of the T-line is a different concept. Nobody has the T-line, or I say the percentage of people that have the T-line on their chart is so minuscule that it doesn't really affect anything. However, because it's so effective, the T-line is like a Fibonacci type number. It's a natural support and resistance level of human nature. So if you add the concept that candlestick signals are the graphic depiction of human nature, or a change of human nature, and the T-line is a natural support level of human nature, when you combine those two, you've got an extremely powerful combination that makes your trading very profitable. So again, the Doji represents indecision between the bulls and the bears. They're opening and closing right at the same level every day. We also demonstrate the indecision with a spinning top. It looks like a spinning top. It's basically a long trading range with a small body. Okay. Which SMA is the T-line? It's not an SMA. It's the 8 exponential moving average. The other ones are simple moving averages. All right, so if you go by the basis of candlesticks, of what the Japanese rice traders have done for us in a graphic depiction, it puts common sense into our analysis. Where do most people buy? They buy exuberantly at the top. There's our overbought stochastics. Where do most people sell? They panic sell at the bottom. So this is just very simple, that if we see the exuberant buying coming in at the top, and we start moving away from the T-line, and we're in the overbought condition, and we know what should happen, our simple rule of Doji, is it's going to move in the direction of how they open it. That tells us if we start trading lower, that far away from the T-line, take profits. It's probably coming back to the T-line. I am also in the process of doing kind of a video format of book 3 on how you can control your emotions using candlestick signals, going into each of the aspects of, some people have a hard time entering a trade. Other people have a hard time taking profits. All the emotional factors, like trading is not just the analysis of the correct time to get in and out. You also have to have a have the mental the correct mental perspective. So you need to get your emotions, and that was always this is why I'm so good at candlesticks now, is because I was the worst investor in the world. My emotions just screwed me up every time I put on a trade. I was even a stockbroker for 8 years. When I started learning what was built into the candlestick signals and knowing what the probabilities were based upon candlestick charts, it told me when to get in and when to get out with a much more clear evaluation. Do you distinguish between spinning tops or dojis when you interpret signals? No, they both represent indecision. So visually, all we're looking at is that we're seeing indecision coming into a situation. How do you set up the T-line on your chart? Just like you would set up the 50-day moving average, which would be putting in a 50 and putting in simple moving average. The next thing is you put in the 8 moving average and do it exponentially, set it as exponential. So, Jim, I don't know how to help Ralph. You might have to reboot. All right, so if you use the logic, where do most people buy? They buy exuberantly at the top. Gaps are usually a very good indication that you're seeing exuberant buying, and then if you see a doji, it makes it very simple. If they start trading lower the next day, that tells you that was that exhaustion up here. Start taking your profits. So The doji represents indecision, especially when you start seeing them gap it up at the top. You can also analyze anything else that's on your chart. Where's the resistance levels? What's happening at those resistance levels? You're in the overbought condition. You're seeing a bunch of dojis at the resistance level. It's getting ready to tell you to start taking your profits. It's just like a neon sign. There's that doji shooting star in the overbought area. Oh, that's our simple rule of a doji. If it opens lower the next day, start taking or close out the position. There's another very simple aspect to candlestick analysis. The bigger the signal, the more compelling there's been a change of investor sentiment. Okay. All right, Ralph. And again, the same analysis. If it opens lower the next day, start taking profits. So candlestick analysis is merely just common sense put into graphic depiction. The bigger the signal, the more compelling there's going to be a change of investor sentiment. Now that's dojis at the top. Dojis at the bottom have a different concept. What we need to see the next day is bullish confirmation. So here very simply is you see some dojis in the oversold condition starting to move away from the T-line. We're looking for bullish confirmation. So if one doji means indecision, a series of dojis means greater indecision. And then when they make that decision, we know which way the trends are going. So that series of dojis also has a relevant factor. Notice how in this pullback, is this pullback very decisive? Definitely not. You've got a bunch of indecisive dojis telling you they aren't selling this off with any great enthusiasm. Then they do a doji, bullish confirmation above the T-line, stochastics coming up. Again, this puts the probabilities in your favor that you're now in wave 1, wave 2, going into wave 3. And it doesn't matter where that series of dojis occurs. The series of dojis occurring up here in the overbought condition, start getting ready to take profits. Now, we also go through a process of teaching that anytime you see a doji in a multiple day signal or a multiple signal, the left-right combo is the little doji followed by a bullish engulfing signal, a little left jab followed with a roundhouse right. Tells you there's been a dramatic change of investor sentiment, and if it's occurring in the right place of the trend in the oversold area, the probabilities again are pretty strong that you're going to have a strong reversal. So the Japanese rice traders make the analysis very simple. If you see a candlestick buy signal in the oversold area, more than likely it's reversed. You're heading in the uptrend. If you see a candlestick sell signal, a bearish left-right combo in the overbought area, more than likely you're going to see a downtrend. So each signal that we go through, we kind of explain what the psychology is. This is a bullish engulfing signal, very simple. It opens below the previous day's close and it closes above the previous day's open. This body right here completely engulfs that body right there. Not necessarily the tails or the shadows, just the body. Arco was one that we bought recently because you got a big bullish engulfing signal. And remember our simple concept? The bigger the signal, the more likely there's been a dramatic change of investor sentiment. So when we can analyze a trend and then a big signal, that tells you there's probably been a change of investor sentiment. If we see in the biggie, like Apple, a big bullish engulfing signal right on the 50-day moving average, the probabilities are that's not the probability. Yeah, the probabilities. Remember, the candlestick signals are not set in stone. The Japanese rice traders have just identified what would be something that showed us there was a change of investor sentiment with the graphics. And that big bullish engulfing signal in the oversold area on a major support level, this gives you a high probability trade that it's time to get in. Oops, we did those. So anytime I see a bullish engulfing, I'm looking for confirmation the next day. And that's another factor that helps get you into the correct trade at the correct time. A bullish engulfing signal on a support level, being confirmed the next day, breaking a resistance level, puts you in a situation where the probabilities are dramatically in your favor that you're now in a uptrend. Bearish engulfing signal opens here, closes here, opens above the previous day's close and closes below the previous day's open. That candle completely engulfing the body of that candle. And once again, the bigger the signal, the more compelling there's been a change of investor sentiment. And when we add the other things that everybody else is watching, which is exactly what we have the advantage of, is seeing where these signals occur. There's our left-right bearish combo, right smack dab at the 200-day moving average. There's a bearish engulfing signal. Where did this occur? Right smack dab at the last little peak, telling us they aren't going any further. You can be shorting this position. Let's see. Would you wait to close for a close above the T line after a bullish signal before entering the trade? Usually, if it's bullish engulfing and it's just coming up to the T line area, yeah, I'm going to wait to see if it opens positive the next day, and if it's close enough to the T line. The best trade setup is to see a bullish engulfing that closes right on the T line. If it opens positive the next day, it basically tells you the T line's not acting as resistance, and it's confirming the bullish signal. Now, on the other hand, if you see a bullish engulfing signal, it's not on this chart, but you see a bullish engulfing signal and it's way away from the T line, then your first target is it's probably going to come up and test the T line. So the worst case scenario is if you're buying, you know, at least when it comes up to test the T line and fails, you're probably getting back out of a bad trade with hopefully a small profit or a break even. The hammer is one of the 12 major signals. And there's no formulas that you have to learn in candlesticks, except for the number 2. On a hammer, the tail is 2 times greater than the body. And basically, the Japanese race traders say that the bears have hammered out the signal, or hammered out the bottom, and the bulls have stepped in. So what we're looking for the next day after a hammer is bullish confirmation. Again, a high probability trade setup. And we're looking for not only that bullish confirmation, but if we're not buying here, we're buying when it comes up through the T line because we've got the reversal signal, now a gap up through the T line. Now we can project where our first targets are going to be, probably back up at least to the 50 and see what it does once it gets there. So the important factor that we can use candlesticks for is the visual analysis of what's happening at major support or resistance levels. If we see a hammer that keeps closing just above the 200 and we see it opening positive the next day, stochastics in the oversold area, that just puts us in the right position at the right time. Now, there's 2 advantages to being able to see what's happening on a confirmation of a signal. Number 1, I had somebody ask me, well, how many days does it take for you to confirm that the reversal has occurred? And the answer is 0. If that's my signal and the next day they're confirming it, we're in right away, which does 2 things for us. If this is a strong trend, we're in very early. Everybody else's confirmation is going to be adding to our profitability as it moves up. Or number 2, if it fails and starts coming right back down through here, it's telling us it's not working, we're out with a small loss. And this is the whole prospect of using candlestick signals successfully. You've heard every money manager tell you to cut your losses short and let your profits run. Very rarely will they tell you how you cut your losses short and let your profits run. Let's see. You showed an engulfing signal with a large red bar. Would it still be bearish engulfing if the large candle was green? No. No, that would be still heading in. That meant it opened much lower and closed high. What we saw was on that red candle. Remember, the candles are created A green candle opens here and closes above where it opens. A red candle opens here and closes below where it opens. Doesn't necessarily mean that the price was up or down on the day. This tells you what happened after the open. Is it a hammer when it is at the bottom of a downtrend? What do you call a hammer at the top of the uptrend? Hammer at the top of the uptrend is called a hanging man, which we'll get to. Does it matter what the body of the hammer is? No. The tail is what is your signal. How do you scan the market? With very simple scans. All you have to do is put in the formulas. The formulas are on our website. Depending on what's, our formulas are all over the place. At Ninja Trader, Thinkorswim, TCNet, Metastock, TradeStation. They've all got our formulas that you can put into your scanning. When you enter above a hammer candle, where would you put your initial stop? Below the head of the that hammer. Would you comment on a hammer and a morning star evening? We'll get to that. It doesn't really matter, Thomas. It's a morning star and evening star signal just has a day of indecision between the two big candles. For all your charts in this demo, what is the time frame? These are all daily. I'm just kind of showing daily charts, but this could be a 10-minute chart. This could be a 1-minute chart. This could be a monthly chart, all depending on what your time frame is. As I mentioned earlier, I used to trade the E-minis off the 1-minute, 3-minute, 10-minute combination. Right now I trade, in the middle of the day, I'll trade soybeans, cattle, the dollar, and I usually use the 10-minute chart as my bellwether and then trade off the 5 and 5-minute and 1-minute charts. E-signal, I think it's on E-signal. People, they all came to us and asked what could they use for formulas, so they're all out there. Repeat the definition of a hammer. Hammer is where the body or the tail is 2 times greater than the body. So it usually has a big tail to the downside. It doesn't matter whether the head is red or green. It's this tail, especially in the oversold area. This is not live. This is not live. I've been called worse, especially when I just sit home at night and Sandy wants to go out and do something. Does the 1233 for stochastics also apply? Yes, I use the 1233 on all. Again, this could be 1233 on a 1-minute chart or a monthly chart. Stock charts should have the formulas. Questions won't be answered. It's a recording. No, we answer all the questions. What is your T-line when trading minute charts? Still the T-line, 8 exponential moving average. So if I was trading on my chart system, and let's say I was looking at this day right here, and I wanted to start trading it, I'd flip to my 10-minute chart, which would look exactly the same as this chart. This is being recorded. What is the red line? The red line is the 200-day simple moving average. The blue line is the 50-day simple moving average, and the gray line is the 20-day simple moving average. All right, buy another mouse pad. That's some of the technical stuff that we have out there for sale. Mouse pads. What else do we have? Flashcards, showing you all the signals. Another set of flashcards showing you all the patterns. And we've got 2-foot by 3-foot glossy posters that every American family should have hanging up in their living room. When you're day trading, what time frame do you use for entries? I look at my 10-minute chart, see what it's doing, and then as soon as my 10-minute chart looks like it's setting up, I'll flip to my 5-minute chart. Then when I'm ready to execute, I'll flip down to the 1-minute chart to make sure that my 5-minute chart and 10-minute chart isn't ready to turn over on the 1-minute chart. If everything is moving in the right direction, I go ahead and execute the trade. And all that takes a matter of click, click, click. So it takes maybe 3 or 4 seconds to go through, just visually see those charts and get ready to put on the trade. Okay, so the hammer signal at the top of the trend is the hanging man. They call it the hanging man because there's his head and there's his legs dangling down. So it has a reverse psychology. The bulls are happy, the bulls are happy. Then there's a little bit of selling and the bulls get nervous because they think the bears are there, but they close at the top end of the range that day, and the bulls say, oh, that was a close one, but I was a little bit nervous. Then the next day when they open it lower, the bulls say, shoot, the bears are still here, close out the trade. So that hammer signal, if it opens lower the next day, you close out the position. Just a very simple, again, that signal right there, the hanging man, tells you the bears are starting to take control. Okay, another major signal is what we call the piercing signal, a little bit different than the, I'll show the hanging man again. Hanging man has a small body at the top. It's a hammer signal, but it's at the top of a trend. All right, the piercing signal is a little bit different than the bullish engulfing. It not only has to open below the previous day's close, but it has to open below any of the trading range of the previous day. So that means it's gapped down below the low of the previous day. Then the second criteria is at number 2. It has to close more than halfway up the candle the previous day. Again, if that's happening in the lower or near the oversold area, that tells you the bulls are taking control. So if you're looking at this chart and you can see a bullish piercing signal and it starts confirming, what's it tell you? There's a double bottom down here. So the graphics of candlesticks are just that much more, show much more clarity as to what's going on in investor sentiment. The deeper they gap this down and bring it back up, the more it's telling you that they've wiped out sellers and the bulls are taking control. All right, thanks. No, I'm not the best educator. I tell people, if you learn from your mistakes, I'm one of the best traders you'll ever come across because I've made every single mistake you can think of when it comes to investing. Fortunately, candlestick signals showed me graphically what I was doing wrong, and all I had to do was turn it around 180 degrees, and now I was on the right side with the smart traders. Dark clouds, same as a piercing signal except at the top of the trend with the same criteria. It gaps above any of the previous day's trading and closes more than halfway down this candle. So this also comes into the element of where do most people buy? They buy exuberantly at the top. So if you see a gap up in the overbought condition, you get ready to start taking profits. And we show how very effectively candlesticks are, or very effective candlesticks are for showing you where to start taking profits with a high degree of probability. So that dark cloud, just it's called a dark cloud because everything's happy. Yep, and there's that dark cloud. And if you see that happening, obviously at a major resistance level, the more compelling it is that that was the point or that was the area that everybody will start to take profits. All right, the other, what was the one at the bottom? Oh, we haven't gotten that. Shooting star. Shooting star has a tail that's 2 times greater than the body at the top of a trend. And they call it a shooting star because it looks like a shooting star with a tail behind it. So if we see that shooting star, if it opens lower the next day, we're taking profits. Now, that's added to the visual identification of the fact that we are that far away from the T-line and it opens lower the next day. The probability say it's coming back to the T-line. Is it going to bounce and we get back in? Have no idea. So why take the risk? If it opens lower the next day, you close it. If it comes back up on a J-hook pattern, you can always buy it back. But and this was what got through my emotional trading, that if I had something to say, oh man, I'm making money, oops, I don't know, is this a little bit of profit taking? I'll hang on to it, and I was usually the one hanging on to it right back down to where I bought it in the first place. Now I know to close out the position and get ready to buy it back if the next signal comes in or the next pattern. you ever use order flow on level 2 or 3 for trading? Very rarely, Robert. I'm usually not trading most of the time that fast. If you're day trading, you can use the order flow if you can see where the big buying or the big selling areas are. No, the shooting star could have a red body or a green body. Again, the tail is the indicator. Somewhat like an evening star, yes. Can you tell me the breakdown of your slow stochastics? Oh, I don't know. All I know is, and I don't have to know. Once I put 1233 in there and they're on my charts, that's all I have to know. Because we're not buying or selling stochastics. We're using the stochastics to tell us where we are in the trend. Obviously, if we see a candlestick buy signal in the overbought condition, it doesn't mean very much. If we see a candlestick sell signal in the oversold condition, it doesn't mean very much. What we're looking for is the buy signal in the oversold area and the sell signal in the overbought area. A lot of people say, well, do you wait for the stochastics to cross? No, I'm just looking to see where they are. The number one factor for when to get in and get out of trades is the signal and where is it occurring. Everything else is a confirming indicator. So if I see that gap up and see a shooting star doji in the overbought condition, I've got one criteria. If it opens lower the next day, I'm closing out the position. Somebody says, do I have scanners? Yes, the scanners are all over the place. Any of the software systems that you have as a scanner. I use TCNet. I use Metastock. I guess we've got the scanning formulas on Thinkorswim. They're all over the place. And Alan, yes, my scanning, once you put in the formulas for scanning, it takes me less than 5 minutes each afternoon to find the absolute best trades for the next day or whatever time frame I'm trading. Even if you're not familiar with candlesticks, it's going to take you less than 20 minutes each day until you get familiar with candlesticks where you can do it faster. Volume doesn't mean anything. We're not buying volume. A lot of people say, oh, I want to see the volume go up as the price goes up. Volume has absolutely nothing to do with price. If you've got a stock that's going up because everybody's buying it and nobody's selling it, it's going to go up on lower volume. Now, there are times where, I don't have volume on these charts, but if this was a big volume day in the overbought condition, a big volume spike, that pretty much tells you there's been a lot of change of ownership. If this day right here was a big volume day, that told you that buy signal was created with a lot of change of ownership. What should be our target and selling point in a shooting star? You don't know based on the signal itself. You look at the chart and see where the next support level might be. Yeah, the target is not predicated on the signal. The signal is telling you there's a change of investor sentiment. Now you look at the chart and see where your potential targets are. Yes, again, we've got the scanning is very simple, and you can apply the formulas to any of the scanning softwares. Let's see. Okay, Dean, thank you. Am I going backwards here? A Trade Navigator, I'm not sure. Don't you find it harder to get out of a position with low volume? Yes. My scanning will have a universe of stocks that are trading above 5 because every time I buy a stock, I want to have something. I know the probabilities are in my favor that it's going to move in my direction. So I want to be able to margin it if I need to. Most brokerage firms won't margin a stock that is below 5. And then, depending on the size of my account, I don't want to be sitting and waiting to get in and out of a trade because the volume is low. So even on a small account, I may say I want all stocks that are trading more than 200,000 shares on average each day. That may take the universe of 10,000 trading entities down to 2,700. But out of 2,700 trading entities, when I do my scans at the end of each day, I'm going to find 2, 3, 5, 7, 12, 15, 20, 40, 80 good setups depending on the market conditions. I'm only probably looking for 1 or 2. So not only do I have the opportunity of finding the good trades, but then I can go back through with a very simple cultivation process, which we'll be showing everybody over the weekend, on how to pick out the best trades. So what it does for you is not only picks out a supply of good trades, but then you have the opportunity, based upon the information you know that's built into the candlestick signals and patterns, to cultivate it to find the best possible trades. How many open positions you have at any one time? Part of my money management is I usually have 10 positions on, and they're all equal dollar amount because, again, my biggest bugaboo was or is my emotions. So if I've got 10 equal dollar amount positions, now I look at those as each as a unit, not as something that is, oh, I really figured this is going to be a good one or better than the rest. It's just a trading unit. Now, I have 10 positions or 8 or 12, somewhere in that area, because it does 2 things for me. One, if something happens devastatingly to one of my positions, it's not going to kill my whole portfolio. And 2, 10% of my position is big enough that I should pay attention to it. I can scan through my 10 positions every night in a matter of 45 seconds to see whether there's something iffy starting and that I have to do something with that position. All scans are in Thinkorswim? I think so, yes. You don't trade options based on candlesticks. You're trading the underlying stock with candlesticks. Options are just a method for taking advantage of the move of that stock. How long do your trades last now? I'm a swing trader, so most of my trades last anywhere from 2 to 10 trading days. What is your risk management percent of portfolio per trade? 10%. If I've got 10 positions on, it's always 10% of my portfolio. Now, I'm usually 100% invested because I'm always going to find more trades than I have money to invest in. But I may not be 100% long or 100% short. In this market that we're going through, I may be 5 long and 5 short. Right now I'm a little bit heavier short because those shorts are working, which I'll show why they're working here in a little bit. All right, there's the inverted hammer. That's the shooting star, but at the bottom of the trend, kind of that reverse psychology. The bears are happy, the bears are happy, the bears are happy. And, oh, the bulls have stepped in. Bears are nervous, but it closes back down at the lower end of the range, and the bears, man, that was a close one. Then the next day when they open up positive, the bears say, shoot, the bulls are back again, get me out of this trade, and it starts the uptrend. Now, unofficially discovered when you see an inverted hammer in the oversold area and it opens positive the next day, again, this is nothing more than just my analysis over the last 40 years. There's probably a 95% probability or greater that if it opens positive after an inverted hammer that you're going to go positive, which also makes the other side of it very simple. If it opens positive, and I already kind of calculate 95% of those trades are going to be positive, where shouldn't trade at all? You shouldn't trade back below this level. If it does, that signal didn't work, you close out the position. When you buy calls a month away, are you planning to get out within 10 days if it is going anywhere, or do you need to sell a sell signal to get you out? Yeah, if I'm buying based on a candlestick buy signal, I'm selling based on a candlestick sell signal. Do you trade uncovered? Are your stops simple orders or use options, protective? If I'm trading options, depending on how many days there are left or how many weeks there are left to expiration, if I'm usually trading the monthlies, so because I don't have time to watch the weeklies as much. Now recently I've been trading some of the weeklies because the the trends of any of the trading entities out there are very small. We're lucky to get 1 or 2 days of going in one direction. But that's a whole different concept. We've got an option trading room as well as our regular trading room where the terminology and the trading strategies in there are all based upon which candlestick signals and patterns are we seeing and which signals are the best. Bullish Harami. Harami in Japanese means pregnant woman. There's her body and there's her body, or her belly snout. And it's known as an inside day in Western terminology, but it opens above the previous day's close and closes below the previous day's open, which has very simple, tells you that the selling has stopped. What do we see that want to see the next day? Bullish confirmation. And if it occurs right on a major support level, that tells us exactly what's happened at that support level. Where do most people sell? They panic sell at the bottom. There's always the question, where do you grab for the fallen knife? Candlestick signals make it very simple with the signal. The opposite is the bearish Harami, telling you that the selling or the buying has stopped. So if I'm buying here on this left-right combo gap up, breaking this resistance level, I'm looking for the sell signal. I'm starting to take profits when I see the bearish Harami moving away from the T-line. If I see an uptrend resistance, the next day they do a bearish Harami, I'm closing out the position. So it just gives you much better probabilities based upon the truisms of candlesticks. Again, the bigger the signal, the more compelling that uptrend is over. Gabe, we go through teaching people how to use breakouts. Why is it called an inside day? Because it opened and closed inside the previous day's body. Oh boy, I don't know how to find the scans. I know they're on there. If you kind of go through their system and look for candlestick signals. How many days out that you buy options? Well, again, that's a whole different conversation, but normally if I'm 3 weeks or more, I'm just buying the calls or the puts outright. If I'm somewhere less than 2 or somewhere around 3 to 1 week out, I'm going to be buying spreads, which are much more effective, and you get great advantage using spreads because of the knowing how strong that signal, reversal signal is, and where the next target's going to be. If I'm less than a week, meaning if it's expiring this week, I'm more apt to be putting on a credit spread. They don't make a whole lot of money, but the probabilities of making the money with that spread is extremely high. How do you differentiate between a reversal signal and a continuation pattern when trading? That's in book number 1, showing you which ones are the continuation patterns. Evening star reversal becomes an upside down gap and continues down uptrend. Very simple. If you see a candlestick reversal signal and the next day it negates, you close it right back out again. Or if it doesn't confirm the next day. So again, this is all, the questions you're asking are all very simple to analyze based upon what would be the common sense aspect of candlestick signals. Well, if this is our morning star signal, a big down day, a day of indecision, and the third day closes more than halfway up this candle, what do we look for the next day? We look for bullish confirmation. If it opened and closed below the halfway point of this candle, the Japanese rice traders would make it very simple. If this was the candle that told you the bulls are in control and the bears had enough strength to close more than halfway down that candle, the bears are still in control. You close out the trade. Does the size of the belly matter? No. Now, bullish and bearish Haramis, let me go back up here, act like barometers. If this was a very small Harami down here at the bottom of this candle, you might see a trend trajectory that looked more like this. If this was a bullish candle that closed very close to the top of the previous trend, your trajectory may be more like this. So that acts like a barometer, shows you how much strength is probably within the reversal. So the Morningstar signal is a 3-signal pattern: a big down day, a day of indecision, and a day closing more than halfway up this candle. So what we're looking for in what I call convergence analysis is, how strong is this reversal? Well, if they gap up from a doji, remember that's what we call your best friend. Anytime you see a doji in the oversold area and they gap it up, that's a very strong reversal signal. If they close well above the halfway point, that's more of a confirmation. And if they close it above the T line, that's more confirmation that you're in an uptrend. So the more elements that we can put into our analysis, this Morningstar signal occurred right smack dab on the 50-day moving average. Had all the elements for buying, because as long as it stayed above the T line, we stayed long. So if we see something like this, knowing that we're seeing a big doji hammer right smack dab on the 200, what do we know should be happening? Well, we know that the trend is going to move in the direction of how they open the next day. So if we wake up, in this case, this happened to be the markets, if we wake up the next day and see the pre-market futures are up 140 points, we're buying immediately, because that told us exactly what was happening after that big hammer type signal that closed right at the 200, that if they're trading it positive, we've got a Morningstar signal in progress. So again, this is not rocket science. This is just taking advantage of the information that the Japanese rice traders have illustrated for us. Ron, I trade the T-bonds when those charts, there's only about 30 charts that you can really trade in the futures area. You can trade the indexes, the Dow, the Qs, the S&P 500. You can trade the bonds. You can trade the currencies, probably 4 or 5 of those. You can trade the grains, 4 of those, soybeans, wheat, corn, and used to trade oats, but they trade too thin. You can trade what they call the sauce. That's cotton, coffee, cocoa, and sugar. So I can go through those charts in a matter of like 2 minutes, seeing which chart has the best setup. So the evening star signal was a big up day at the top of a trend, a day of indecision, and the third day closing more than halfway down that candle. So we make our decisions based upon where are we in the stochastics, and what signals. Again, the signals are the #1 criteria. Everything else becomes confirmation. So once we see an evening star signal, we know that if it starts trading below the T line, we should be in a downtrend. And the one thing that we look for is the strongest of all the signals, which is the kicker signal. Kicker signal is when it's in a trend, it opens here and closes here. The next day they gap it up at or above the previous day's open and goes the opposite direction. In an uptrend, you have a bullish candle, opens here, gaps up here. Next day, they gap it down below the previous day's open and go the opposite direction. And it used to be that I would be so happy, I'd have a good positive trade, positive trade, positive trade, and then some news would come out and they'd gap it down here. Before the market opened, I'd sit there and say, oh man, if they would just take it up one more time and let me out. But what I discovered, if they can gap it down below the previous day's open in an uptrend, the sellers are in control. So anytime I see that gap up, the kicker signal has the strongest probabilities of creating a very strong uptrend. A flutter kicker signal is what we teach people. You have a down day. The next day they gap it up and do a doji. Not very indicative of anything, other than the fact we already know they gapped it up above the previous day's open. And we know the simple rule of a doji. If they open it positive, they're going to move in the direction of how they open after a doji. So we're buying immediately because they're probably going to move positive and create a flutter kicker signal. We call it a flutter kicker signal because if you took this little flutter out of here, you basically have a kicker signal, which is your strongest signal. And this signal works very effectively. Tells you there's been a dramatic change of investor sentiment, and we're seeing a lot of those right now with earnings coming out. Bearish kicker signal, Whoops, I skipped one. Kicker signal, they kick it this way. It tells you they want to get out in a hurry. If you happen to be long, the first thing you want to do is close out the position and get ready to go short. This is the advantage of the chat room that we have, because we have everybody looking for the same type of signals. Today, our PCMI was identified as a kicker signal. Opened here, closed here, probably the earnings kicked it in this direction. What's it tell us? There's probably going to be a lot more upside to this trade. So also with signals, we show how signals with gaps work very effectively. And again, that's where kind of the best friend signals and those type of things work more effectively. A Doji gap up, Morningstar signal, close above the T-line, tells us there's been a dramatic change, a high probability trade. We also can use patterns. There's our fry pan bottom breakout. Notice how they broke out. They gapped through this level. So when we do the patterns, remember, we just went through a whole process saying we want to see the buy signal in the oversold area, except with a pattern. The pattern breakout is usually going to occur when the stochastics are already in the overbought condition. Might see a kicker signal in Amazon to the downside, yes. Do you exit on a daily chart or an intraday chart on the kicker signal? Usually you're not going to have an intraday kicker signal because it's a gap during the day. Usually it's going to be from day to day, that if I'm in an uptrend and the next morning they're gapping it down below the previous day's open, I close it immediately. So we're looking for patterns using the candlestick signals for the breakouts. We know what should happen coming out of a fry pan bottom, a very strong price move. We also, again, add to our probabilities of being in the right trade that if we see a close below the T-line, the probabilities are higher that it's time to be out. The only big trades that we've had recently are being short some of the biotechs. We can see we had a sell signal here and a close below the T-line. This makes it very easy to sleep at night, knowing that all we have to do is stay short until we see a buy signal way too far away from the T-line, or a buy signal and a close above the T-line. We recommended EVH today because notice what happened here. We had kind of that little wedge and it broke to the downside, closed right here in the resistance level. We just put out a very simple strategy. If it opens lower, short it. It's still heading down. And we also recommended LabD, which is the bearish biotech fund. This is what we call the classic pattern, which we show people these simple patterns because the patterns are created by the fact that investor sentiment, people think the same way time after time. That's why patterns set up. There's a big fry pan bottom. There's a J-hook pattern. We know what should come out of a fry pan bottom, a very strong price move. We know the prerequisite for a J-hook pattern, a very strong price move, and then notice how it pulled back indecisively. So this move right here should be the same as this move right here. So essentially identifying the signals and patterns for the signals. Notice how this started back up. There's that left-right combo confirming, and it broke out through this level. It tells us there's probably more upside, or meaning there's more downside. The 12 major signals, there's probably about six patterns. Again, are very easy to identify. One of them being the J-hook pattern. Again, what we can see graphically is when something has changed in investor sentiment. So I always tell people, are we always getting into positions where we're buying here and 3 days later, I think we were buying here at 15 and 3 days later we were selling out around 45? Definitely not. But there's a high percentage of the time where we have the probabilities in our favor of being in these type of situations. So two basic elements of candlesticks analysis is it puts you in the right situation at the right time with the expectation that we should know what should be happening. On the other hand, we should know what should be happening, and if it fails, we're right out of the trade immediately. Back to that very simple concept, cut your losses short and let your profits run. So again, that's the 12 major signals. I will flip over here in a minute to live charts to look at whatever everybody wants to look at. However, we're doing a 2-week or day training. This is kind of our bread and butter training. And this is we got priced, so it's well worth everybody's money. This is the link. Whoops, that's not the link. This is the link to get there. This is a training where we start 9 o'clock, or I guess it's 9:30 on Saturday morning, and we go right through from the very basis of candlesticks, starting with the Doji, going through the 12 major signals, then how those signals work effectively for identifying the big breakout patterns, how to use entry and exit strategies that improve the probabilities of being in the right trade at the right time, how to set your stop losses, how to take profits, how to do simple scanning techniques. This is not rocket science. It will be recorded, yes. So if you can't sit through the whole 2-day session, you'll be able to come back and you get the recording. You can study it anytime you want to. So candlestick analysis, again, it comes down to one basic concept. The Japanese rice traders identified what moves prices, which is basically human emotions. So with that, I'm going to turn off this screen and I'll pull up some live charts and we'll go through some of the things that are working well right now, and kind of also with candlesticks, not only can you identify which individual stocks, commodities, currencies, or whatever you want to read, but you also have the capability of identifying or analyzing which way the market trend is moving. Let's see. Close this out, move this over. So, I mean, simple logic. Now, we had one of our training sessions in August at Cuca Lake up in upstate New York. The market had already looked like this. We kind of anticipated it was going to break out one way or the other. Well, it broke, and then look, it's moved sideways. Okay, you ready to go? So this is how long it takes to analyze what the market's doing now. If it looks something like this, we can see that it's broken out. We should be long. If we see something like this, we know it's time to take profits. If we see something like this is the longest I've ever seen the market move sideways in quite a few years. So you might not be long, you might not be short. Now, I can look at this chart. The NASDAQ, whoops, I don't know whether I can get the S&P 500 over here. Nah. The transportation index and the S&P, all in the matter of probably 10, 12 seconds. And if you can analyze, all of them are moving sideways, you can pretty much analyze they're all moving sideways. If they're all looking somewhat like this, you know they're in an uptrend. So that kind of puts the common sense of investing in your favor by knowing that if the market is heading up, you can just as easily scan to see which sectors are going long or short. Right now we know the biotechs are still in a strong downtrend. That's why we've stayed short the biotechs. That's why we've brought long the inverse, whoops, the inverse of the biotechs, which is Lab D. There's our kind of our cup and handle or our classic J-hook pattern, so we can be long that one. We can identify, and this is another if we train, notice where the buy signals occurred on Western Digital, right smack dab on the 50. Then a big bullish engulfing, and it gapped up today. We know what to expect from this trend. If it opens positive, it's going to move up to this trend and continue higher. So even though the market's moving sideways, we can pick out which stocks we can still be in, even though out of 2,500 trading entities, we might be only down to 4 or 5, but those 4 or 5 are going to make us money. I day trade and swing trade. Yes, it works for all time frames. Hold on to your individual ones here for a second. Let me just kind of show. So here's the what's happening with the earnings reports. That's not what's happening. What did I do? Oh, that's a good looking chart. I didn't. You can see the J-hook pattern and notice where the inverted hammer. Notice where the port is. That wasn't the one I was looking for though. It was S-fly. There's your best friend gap up, and it closed above the 200, closed at the 50. What's this tell us? If it opens positive tomorrow, we've got what we call 45-degree in progress, which means this best friend tells you there's been a drastic change of investor sentiment. There's probably going to be residue upside to this one. TPX, very simple rule of the Doji. Notice they gapped this up today. If it opens positive tomorrow, you can be buying immediately because that tells you today's profit taking is over, and they're going to move it in the direction of how they open it after a Doji, and we've already had a Doji gap up with stochastics coming up. First logical target's here at the 200, which coincides with this gap area. If it breaks through the 200, it's probably coming up above the 50. Now, will it go there? Who knows? When we make our analysis, the first thing we want to be able to do is see whether it's worthwhile to be in that position in the first place. If we can identify a stock that has a potential of moving up 30% versus a stock that has a good chart that has the potential of moving up 4%, obviously we want to go with the ones that have the 30% upside potential. So there's the kicker signal on MB, MindBody, based on their earnings. If it opens positive, where's our first target? Well, at least we know we're heading back up here. So the worst case scenario, if it gets up here and fails, at least we're in a situation where we're coming back out with a little bit of a profit. What would you do different to trade the E-minis? I don't know whether I get them over here or not. But it's all the same. No, that's not it. F.ES. Is this the E-minis? I don't trade the E-minis off of this chart, but I do trade the dollar. You can see what's happening in the dollar. You can see where it broke out, and this is another thing we'll be demonstrating to people, is how do you identify or analyze what the chart is telling you based upon the patterns everybody else is watching. You can see the wedge. You can see when it broke out through the wedge, and this is what we call a Doji sandwich. Notice how we had a big day, a Doji. Our very simple rule of the Doji is to open positive. This day right here and this day right here are usually the same. So if that's the case, we're buying right here because we know if it moves up this amount, we've broken out of this wedge. We're in a strong uptrend. This signal is DXAZ6. For MB, stochastics are not oversold, already up. How do you manage that? Remember, I should have clarified this. You're not in the oversold area. You're coming up, but remember, the kicker signal is the strongest of the candlestick signals. You can pretty much disregard the stochastics on the kicker signal because it's such a strong signal. Fry pan bottom. This must be a bigger. Well, I don't know what that was all about. That's surely not a fry pan bottom. So I goofed up somewhere. And Brinks is what we call a slow curve. You can see how there was a slow curve right here, kind of a much shorter fry pan bottom. But notice how this started with a couple candlestick signals that we know what the probabilities are as a result. Look where our left-right combo. Just the fact that it had a left-right combo in itself was a strong indication we were now in an uptrend if it opened positive. Behind it, they did a Doji sandwich. We know what the results of a Doji sandwich are. more upside. If we have more upside, what's happening to this resistance level? It's breaking out. So we're buying this one based on the fact that if this is wave 1, this is wave 2, wave 3 should be the same magnitude as this one right here. Left-right combo is a doji followed by a bullish engulfing signal. Was Hain? Oh, that's right. Hain had the fry pan bottom. You can see this right here is a big rounding bottom. You couldn't trade this one way or the other. No how. No, that's not correct English. But there's one very simple aspect to a fry pan bottom. You can stay long in a fry pan bottom as long as it is above the T line. And if you get back up to this level, what are we looking for at that point? A breakout. And if it breaks out, remember the result of a fry pan bottom, and one of the 6 or 8 patterns that we follow is going to have a very strong price move. So again, what we're looking at is situations. Yeah, that was a bearish engulfing signal today, but remember the fry pan bottom. So this is telling us one of two things. As long as it stays above the T line, we're still in the fry pan bottom. Now, if we had owned this and tomorrow they open it lower and take it down through this trajectory that told us this fry pan bottom didn't work, close out the position. I don't trade the Bollinger Bands. We usually, John has been on our chat room a couple times doing sessions on Thursday nights. For those of you that are new here, we do a session Thursday night, which is usually open to everybody, and we do a session Monday night, which is for the members. And we go through kind of the analysis of what's going on in the markets, which sectors, which commodities, futures are working well. So we can look that if we're looking to buy gold stocks, we can analyze gold very quickly. We can see gold is going nowhere. So that means we're probably not trading gold, which means things like NUGT, which has been in a downtrend, the T-line interested investor is the 8 exponential. Oh, no, you answered. Okay. Alex, the T-line is the 8 exponential moving average, a very simple concept. If you see a buy signal and a close above the T-line, you're in an uptrend. If you see a candlestick sell signal and close below the T-line, you're in a downtrend. Right now, you can analyze that we're in a downtrend, and what was kind of the visual confirmation of that? You can pretty much draw a line right down through the tops. Where do you think the next target will be? You can draw a line right down through the bottom, so it's probably coming down in this area. How many days to select in chart for understanding the trend? For intraday and swing trade. Oh boy, how many days to select? It doesn't matter. You're just looking at the trend in general. And then you're looking at what is going on right here. So right here, this is telling me I want to be short NUGT because that means my next target is probably down in this area. That's about a 25% downside potential. Okay. Oh, so again, we haven't been making very much money on the long side, but the short side has been working well. Again, a very simple rule. If you see a candlestick sell signal close below the T line, you can stay short until you see a candlestick buy signal and a close above the T line. We saw this one, CVRR, one of the refineries. Well, they must have had bad earnings or something because there's the Doji gap down. This tells me there's probably more downside to this one. HUVG, kicker signal to the downside. Pretty much a good indication that when they broke support level, there's still going to be some more downside. The red and blue line, fast and slow stochastics. They're slow stochastics, but one's the fast of the slow and one's the slow of the slow. And there's ACOR. Notice what this did, this little rounding top. That's kind of an opposite. That's a bearish J-hook pattern. So if this is wave 1, which was about 8 points, this could take you all the way down into the $11 range. The kicker signal, I'll have to find the kicker signal. Oh, PCMI had a kicker signal today, which was the current trend was going in this direction. The dark candle was created by opening here and closing here. The kicker signal is where they gapped it above the previous day's open and went the opposite direction. I told you there's been a drastic change of investor sentiment. They've kicked it in the opposite direction. Haven't really heard about the three waves. Things move in waves. That's why Elliott wave was so, everybody followed it, except Elliott wave was not a very conclusive or defining method. So we know that prices move, and I don't go any more than three waves. Let's see, this is crude oil. You can see crude oil broke this downtrending channel and has been pulling back. So what it looks like it's trying to do right now is might be hovering in here, but it's not doing anything of any great magnitude one way or the other. So crude oil is pretty bad, but some of the crude oil stocks like Whiting bounced up off the T-line, I'm sorry, the 50, and closed above the T-line today. Not a real strong reversal signal, but probably tells you at least you're in an uptrend. I don't trade the currency pairs. You can. You just won't get gaps and that type of thing. But you can trade the currencies just like you trade anything else. WAC is doing a J-hook pattern. This is your classic. Notice how this is what we call the bobble, which is a more defined J-hook pattern, which we teach people. That notice when it failed at the 50, when it pulled back, what it couldn't do, they couldn't close at the T-line. So if you took profits right here and saw that it wasn't closing below the T-line, you could be buying back because that's the bobble breakout. And we know if this is wave one, wave three will be the same magnitude. So there's lots of things that, again, that's a wave, basically a wave one, wave two, wave three. So again, candlestick analysis is very simple. Prices move in the same manner time after time. Is the T-line a 200-day simple move? No, the T-line is the 8 exponential moving average. That's this little black line right here. This is the 200 moving average. Soybeans has not been doing much of anything. Whoops. I guess it is. Soybeans is still in a nice steady uptrend. It was wheat. Maybe it's doing, there's a little morning star signal. You might be wanting to look at wheat starting to break out. Let's see, cotton. Cotton is just kind of stuck sideways in a wedge, so it's not tradable. We did gold. Gold is not moving one way or the other, so we don't trade those right now. Let's see, I think I've got about all, so this is what we also want to look at. We want to look at what everybody else is watching. I think I can do this with some elegance. You can pretty much draw this trend wedge. When it broke to the downside, that pretty much told us the probabilities are pretty strong. They're heading down further. Now, where's our next target on this little, notice this is like a little kicker signal. Opened here, closed here, gap down. You shouldn't see a tail to the upside, but this still represents the same thing. There's been a drastic change of investor sentiment. Where's your next likely target? Right down through here. It could be heading down a lot lower. Do you trade below $5? Not usually, but they work. Candlestick signals work on anything that has fear and greed in it, whether you're trading a 40-cent stock or a $400 stock. So the thing that you want to get accustomed to is there's that kicker signal. Where's your next target? Probably down here at the 200-day moving average. What we would look for This is the opposite of a fry pan bottom. This is what they call a dumpling top. Notice when it got right back to this level, they started breaking it down with a bearish doji sandwich, which told us there was going to be more downside. So is this already gone? Probably. You're getting pretty close to where the support level is. So what we're looking for is things that may be setting up for that same type of situation, like MTH. Notice what it did today. Kind of a not quite a kicker signal, but it broke this level. That told me there's probably more downside on this one. Or GOV. There's that slow curve. Another one that could have a wave 1, wave 2, wave 3 to the downside. So essentially, knowing that the patterns have a much stronger force to them, we're looking for the patterns that's telling us that there's bigger probabilities of a fast move from that pattern versus just slow uptrend or slow downtrends with the market. Does a T-line work on small TF like M15? I don't know what that means. The T-line works on any. This could be, this is a daily chart. This is my 5-minute chart. Looks exactly the same as time frame. Yeah, it works just as well. If I'm trading, today I was trading live cattle. I'm sorry, lean hogs. So I was buying right here. I bought here when it broke out, sold up here. I've got a simple rule. When they open it and they take a big run, the first time I see any selling, I take my profits. Where are they likely to move it back to? This is the 5-minute chart, right back here to the T-line. Where's my next buy signal? A morning star signal. So I'm holding it up here, took profits right here. So again, this isn't rocket science. This is the graphic depiction of what goes on in human nature. Wave you were talking about, similar to Elliott wave. No, Elliott wave, I mean, waves are waves. Elliott wave or kind of illustrated the fact that there were waves. So as long as we know there's waves, we've just kind of minimized it to say, all right, we got a wave 1, wave 2, wave 3 type situation. Once it gets up here and we take profits, now we're looking to see whether this is wave 1, wave 2, and the next wave. So, we're not trading the waves per se. We're trading waves based upon where is there a reversal signal, and if it breaks out to the upside, we're now in wave 3 again. Oh, what if I can get the SPY over here? Okay, this is the 5-minute on the SPY. This is the daily. As you can see on the daily chart, there's really nothing here to say we want to be long or short. We're just sideways. And that's the same analysis you would give to the NASDAQ. Now, it looks like the NASDAQ's selling off, but it looked like the NASDAQ was selling off here. Looked like the NASDAQ was selling off here. So there's been so many times where we can analyze the fact that we are just a sideways market because it doesn't last one way or the other very long. Should you have entered after the Doji confirmation and before the big up move on the last chart? Oh boy, I don't know what the last chart was. Yeah. Oh, on hogs? Whoops. Lean hogs. What was the question? What about the 5-minute? Let's see. I believe the hogs. Let's see. Open. Let's see. All right. I guess. All right. Let me do a few. Let's see. Micron. So the analysis of any chart is very simple. We can see we got a scoop type pattern, which is one of the patterns. Right now, if you're long, I would advise staying long as it stays above the T line. If you're looking to go long, I would wait until it breaks out through this level. So you can analyze based upon what the charts are looking like of when to get in and when to get out based upon seeing where the investor sentiment is starting to change, or there may be a new investor sentiment. Hawk Industries, am I still on the daily? Right now, because of that evening star type signal, I would stay short. Now, obviously, you're on the bottom of the resistance level, so this makes it very simple. You're not quite in the oversold area, but there's a safety stop. If I was short, I'd put a buy stop right here. It shouldn't come back at level. If it does, what's it telling us? It's probably bouncing back up to the T-line. You like the recording guy's picture? All right. You ought to see Pat's picture on here. When she puts her picture up, I can't get anybody to watch the charts. Let's see, I got to scroll all the way down here. That's a good best friend signal. Yes, that's a good looking chart with the hammer gap up, broke this downtrending channel, came up through the T-line. Yes, I'd be a buyer of this one, and I would just watch to see what it does at this level, but I'd expect it's probably heading back up to the trend trajectory. And fossil on the downside, I would go short on any weakness, especially if it came down through this level, which is right where it is, because you've had that wedge breakdown. For breakouts, do you use the close or the high? All depends on how far apart they are. If it's a big move to the upside and comes back down, I'll use the close. If the close and the high are pretty close together, you want to see that it's breaking out through that level. Okay. Again, we were doing the training session. And again, the training session is you show up in your pajamas with your hot coffee at 9:30 in the morning. And we will start with the basic signals and the confirming indicators. Once you have that, we can go through the rest of the 12 major signals and analyze each one on an individual basis to show you where they work, why they work, and what the psychology is that created those signals. Once you understand the visual, Michael, the charge is much less for members. I think it's, if you email Abraham at Candlesticks Forum, he can give you that information. But for members, it's much less. But the one thing that we try to do on all our training is give you way more than your in your money's worth. I, again, was the worst investor in the world. I even got out of the business because I realized that the brokerage firms had no more idea what made prices go up or down than anybody else. Then when candlesticks came along, I looked at it and said, well, this makes sense. And the more I looked at it, the more sense it made. So if you just keep in mind that candlestick signals are merely the graphic depiction of what goes on in investor sentiment, and you understand that, you've got a much firmer grasp of what goes on in the markets. And I can honestly say, being the worst investor in the world, all I had to do was change my analysis 180 degrees, and now I pull money out of the market consistently every month. So with that, everybody have a good evening. We'll hopefully see you in the chat rooms. We'll see you then.